This video is not about memorizing pattern. It's about understanding why patterns work, when they fail, and how professionally actually use them. This is where we go deeper. And today, we are starting with one of the most powerful tools in technical analysis, chart pattern. Chart patterns are one of the most widely used today in trading. More than 70 to 80% of traders and analysts rely on them in some form. Why? Because patterns are not random drawing. They are the visual results of human behavior in the market. I professionally use chart patterns across multiple time frames and market conditions, because when used correctly, they reveal market structures, highlights potential reversals or continuations, and help define targets, risk, and invalidation clearly. This is the foundation video. I'm not breaking down individual patterns yet. Instead, I'm explaining how patterns are formed, how to judge if a pattern is reliable, how to know whether a pattern is reversal or continuations, and why volume and location matters more than the pattern's name. In the next videos, we will break down each pattern one by one. Here are some things most traders miss. Patterns exist because people behave the same way in the same situations. Traders place buy orders near support, sell orders near resistance, and react to averages, trend line, and key levels. When enough people do the same thing at the same time, a pattern forms. That's why patterns worked before they were named, and why they continue to work even after everyone knows them. Every chart pattern has an internal nature. Some are bullish, some are bearish, and some are neutral. But location decides behavior. A bullish pattern after a strong downtrend often becomes a reversal, while the same pattern during an uptrend usually acts as continuation. Never judge a pattern alone. Always ask what the pattern's nature is and where it's forming in the market cycle. Patterns like symmetrical triangles, ranges, and compression structures are neutral by nature. They become bullish or bearish only based on location. In an uptrend, they often continue the move. Near major resistance or distribution zones, they can reverse. Context is everything. A pattern is not valid just because it looks clean. A pattern becomes tradable only after confirmation. Confirmation can be a strong close beyond the structure, multiple candles holding above or below the breakout level, increasing volume on the breakout, and most importantly, clearly, if you have to force a pattern, it's not real. Never anticipate patterns. Seeing a possible double top doesn't mean you have a double top. Until the neckline breaks, nothing exists. Let the market confirms first, then react. Volume is the missing piece. Declining volume during a move signals weakness, while rising volume on breakout shows real participation. Many patterns fail not because the pattern is wrong, but because volume never confirmed the move. We will go much deeper into this in future trend analysis videos. Most patterns offer at least a 1-to-1 risk to reward structure. From there, 2R and 3R levels often act as reaction zones because different traders exit at different risk levels. When many targets align, Price reacts, this is order flow, not magic. A pattern is only considered failed if it was confirmed first and then price move against it. If one trader waits for a 2% confirmation and another wait for 5%, the same move can be a failure for one and non-existent for the other. That's why confirmation rules depends on your strategy. Chart patterns are not shortcuts. They are a structured way to read crowd behavior. When you understand the market phase, location, volume, and confirmation, patterns become powerful tools instead of random shapes. This video is the foundation. In the next videos on Immortal Trader, we will break down the most effective patterns one by one. And I will show you exactly how and why they work. If anything wasn't clear, drop your questions in the comments. I will answer it. See you in the next one. Stay sharp.